Good day, students. Welcome to Pinand ACCA learning. This is session 3, and we're still in cost of capital. Today, our focus basically will be on gearing and ungearing of betas. It's a very common area that can be tested in the exam. And after this session, you'll be able to understand when there's a need for you to ungear and gear back and calculate your cost of equity. Now, let's get down to business. We say gearing and ungearing of betas. When a company intends to, e.g., diversify into a new business that will affect the company's existing business risk, a risk-adjusted cost of capital should be calculated using the geared betas. Geared betas are calculated using the following steps. Step 1, ungearing the industry betas. In bracket, the company is diversifying into their gearing ratios, i.e. debt over equity or debt over debt plus equity. Number 2, convert the ungeared betas in step 1 to geared betas using the company's own gearing ratio. Number 3, then insert the geared beta from step 2 into the CAPM formula to calculate the cost of equity, KE. Now, let me draw a quadrant to explain what businesses needs to calculate a risk-adjusted cost of capital. Now, a business may be diversifying into a new line of business that is totally different from its existing business. So imagine a manufacturing company is trying to diversify into the financial services sector or like the banking sector. So what happens here is you have to calculate a risk-adjusted beta that reflects the risk attached to the new businesses diversifying into. And of course, its existing capital structure is not expected to change. When I mean its existing capital structure, we'll get to capital structure theories in the sessions that will follow. It's your level of debt compared to your level of equity in your capital structure. Now let me draw a small quadrant that throws more light on what I'm trying to explain. Okay, now on top here we have the financial risk, for example. By the side here we have business risk. Let me represent BIZ. Now let me say here, I will say same. Let me say here, I will say same. Here I will say same. Okay, let me see. Okay, let me push this one back a little bit so I can have space there. Business risk. Okay, better. Let me say same. Here, let me put change. And here, let me put change. Now, the thing is this. If a business wants to diversify or it wants to appraise a new investment, many times it's not appropriate to use this existing cost of capital in appraising that investment. It means that for this new project, the company is expected to calculate a risk-adjusted cost of capital that reflects probably its existing business risk and that of the new business is diversifying into, providing its financial risk doesn't change. Now you'll be hearing of two things as we're solving. You have equity beta, which is BE. We say equity beta measures both business risk and financial risk. Financial risk here means your debt over gearing level, BE, while your asset beta, BA, Okay, equity beta. Okay, asset beta measures only the business risk. So we'll come across the assets and debt beta, asset beta and equity beta as we move along. We use the formula in solving our question. It is that formula you use to gear and ungear. And let me show you the formula in the formula sheet that we're giving to you in the exam. This is it. The asset beta formula is given to you in the exam. So this is the formula we use for gearing. In solving asset beta, which is the BA, we have to use this formula. I need to say something here. In the ACCA exam, it's assumed that this whole part is represented by 0. So it is only this part that you will have to deal with in the exam. So it's like saying this first bracket plus 0. So it's left with only the first bracket. So I can write this as BA is equals to VE all over VE plus VD 1 minus T, which is the tax rate, times the equity beta. So we are saying the whole of this part, we are representing it as 0. So we'll only use the first one, which is the first bracket. Now let's go back to our explanation. Now, say this way. If a business is diversifying into a new business, as you move along, as you go to your those of you that will take advanced financial management as your optional paper at the advanced or final level, what you see there is that you may be having more complex things like divestment, the merger, acquisitions, and the rest of them, or restructuring. These things affect the betas, the asset beta of a company. So there may be a need for you to ungear as you solve questions. But at this level, the examiner keeps it simple. It keeps it at just a business diversifying into a new business. So we're going to keep it simple, so we'll keep using the word diversifying and diversifying. So assuming a business is diversifying into another business area that is different from its business area, it means that the business risk will not be the same anymore. Now, if the financial risk will be the same and the business risk will be the same, then it is appropriate for you to use WACC, which will solve as we move along. It's appropriate for you to use WACC to appraise your investments. If your business risk is the same, if your financial risk is the same, and your business risk is going to change for any reason, then you will need to calculate a risk adjusted cost of capital. If the financial risk is going to change for any reason, and the business risk is the same, it's appropriate for you to use APV, adjusted present value technique. If the financial risk is going to still change and the business risk will change, you are expected to still use adjusted present value technique. At this level, you will not be asked to calculate any question as regards adjusted present value technique. You see that at the advanced level, but you can see here that it is appropriate to use WACC for investment appraiser when the when the business and the financial risk is the same. It will not change. Once the business risk is going to change, then the risk adjusted beta, the risk adjusted cost of capital should be calculated for the investment appraisal. Now you may come across questions when the examiner will ask you, when is it appropriate to use WACC for investment appraisal? Then I will tell you, one, if the business risk doesn't change, 2, if the financial risk doesn't change, then 3, lastly, if the project is small compared to the company as a whole. So these are the 3 reasons, or these are the 3 situations where it is appropriate to use WACC to appraise investment. Now let's go to simple questions, but before we go there, I would like to explain the VDVE terminologies. What does VE and VE means? You see that a lot when you're solving WACC as we move along, but let's just see how to understand the terminologies. Now, it says understanding the VE and VD terminologies. There are 3 ways VE, which represent the market value of equity, and VD, which may represent the market value of debt, can be calculated. One of the ways the examiner can give you the question for you to calculate VE, VD. See, the examiner may give you the debt to equity ratio, e.g. debt to equity ratio of XY company is 2.5. This means that VD is 2, VE is 2, because it said debt to equity. So this is debt, this is equity. So anywhere I see V, I simply write 2. Anywhere I see VE, I simply write 5. Number 2, the examiner can also give you percentages expressed as gearing levels. It comes in 2 ways. It can either say gearing is debt over equity, or gearing is debt over debt plus equity. Gearing has 2 formulas. Now, e.g., what is VDVE if the gearing level of a company is 40%? Using the 2 ways of solving gearing. 40% is 40 over 100. Using debt over equity, it means where I have debt, I will put 40% or 40. Where I have equity, I'll put 100. If I'm using the first formula, that's what I will get. So VD will be 40, VE will be what? 100. Now if we're using the second formula, debt is equal to debt plus debt, gearing is equal to debt over debt plus equity. What I will do here, debt, I say the gearing level is 40%. That means debt is, the D here, the D is 40%. But because you say debt over debt plus equity formula I'm using, it will be 40 here for debt, and the balance will have to be 60. So these 2 gives 100. So that is 40 over 100. So where I have debt, I'll write 40. Where I have equity, I'll write 60. So listen to the instructions of the examiner. Another way the examiner can give you will be, the examiner may also give you market value of a share of a company, as well as the market value of a $100 loan note. Now, let's see a simple example. E.g., what is VDVE if a company book value of equity is 10 million and its nominal value per share is 50 cents, and the share is trading at $3.50 per share. The book value of the company loan note is $5 million, and each loan note is currently trading at $105 per $100 loan note. Now, this is one of the ways the examiner can give you questions, and you'll be expected to find VEVD by making simple calculations. And let's see how we can do it. Let's start with VE. Now they gave us the book value of VE. The book value is simply the value you have of the value of equity you have in the account. So just look straight into the statement of financial position that is given to you in the question. Extract the figure you have there. That is the book value. Except the examiner is making reference to say use book value. If it's not making reference to that, that means you're expected to find the market value of equity or debt, which represent VE and VD respectively. So let's see. I know to get the number, and if you tell me the book value of equity is 10 million, in the books is 10 million, all I need to do is to divide it by the nominal value of the share, which is 50 cents. If you have dollar on top, if you're using dollar down as the denominator, if you're using cents, this numerator has to be cents and the denominator has to be in cents. So since the numerator is in dollars, in hundreds, I had to convert the cents to the dollar, like $100 of $100, and that's $0.5. So I can make correct division. Now, if I do this, this will give me 20 million shares in the company. Now, to get VE, all I need to do is just to multiply it to the current trading value of the share, which is $3.5, and this will give me $70 million. So this means that my VE is going to be $70 million. Now, to get for my VD, what I will do here, the examiner have told me that each loan, $100 loan note is currently trading at 105. For every $100 in the loan that I took, the market value is 105. And in my financial statement, in the statement of financial position, I'll look at it, and what they have, what I've extracted here is that the book value of the company's loan note is $5 million. So all I need to do is to put $5 million. You're telling me that for every $100 in the 500 million, for every $100 in the $5 million, is currently trading at 105. So for every 100, it's currently trading at $105 for each 100. Therefore, the VD will be equal to 105 million. So simple ways of calculating VD, 3 ways of calculating VE and VD in the examination, which you use in calculating, for example, your gearing and ungearing, using for the gearing and ungearing method, as well as using it for WACC calculations. And let's move on. Let's see simple questions. It's a Pinand Limited currently operating in the manufacturing sector. This is current industry, manufacturing. Its current equity beta is 1.2. We have to use the formula here to go on gear, but let's go back to the question. 1.2. And debt to equity ratio is currently 3.5. So this is one of the methods we're given, 3.5. So that means debt is 3, equity is 5. The company tends to diversify into the oil and gas sector. AKP, a company currently operating in the oil and gas sector, have an equity beta of 1.1, and its debt to equity ratio is 2.5. Risk-free rate is 5%. Risk premium is 7%. Tax rate is 30%. Required: calculate the equity beta to use in solving the cost of equity, and calculate the cost of equity or risk-adjusted cost of capital to use in appraising the new investment. So let me do the first one. Now we are diversifying into the oil and gas sector. I will need to ungear the business risk in that oil and gas sector and slot it into my existing capital structure. Remember, when you're ungearing using the industry you want to diversify into. You need to ungear their asset beta. The asset beta, as we said before, the asset beta measures only the business risk. So we need to ungear the asset beta from the oil and gas sector using their capital structure in the oil and gas sector, and insert that asset beta measuring that business risk into our existing capital structure. Then we will now have a new equity beta, which we use in calculating CAPM. So let's go back. So in ungearing, the formula I gave, this formula, I'm just writing it out, this one. BA is equals to VE plus VD, 1 minus T. There's tax. If there is no tax, ignore taxation. All right, BE. Now let me fill this up with from figures, please. VE, they've told us, remember we are diversifying into an industry, so we need to ungear their asset beta. So how do I ungear? What is the asset? How do we get the asset beta? Sorry, BA. The asset beta, that's what we're looking for. Now the company we are ungearing from, or the company we are diversifying into, has an existing beta of what, 1.1, and debt to equity ratio of 2 and 5. So that means VE is 5, 2, VD is 2, 1 minus T, which is 1 minus 100, because let me just say 0.7. Tax is 30%, so 100 minus 30% is 70%. Makes it faster for you. 1.1. If you do this, BA will be equal to 0.86. Now, what we've just done here is we have ungeared to get the business risk of the oil and gas sector. Now we need to slot that into our own capital structure. Remember, the capital structure we use here is the one for the business we are diversifying into. Now we need to slot this into our own capital structure. Alright, trying to manage the space. Okay, let's go on. Next one we're doing, this is called 2. Let's see. If I'm going on gear back, I'm just going to turn the formula upside down. VD 1 minus T. VE. Just turn it upside down, multiply it by BA. If you do that, BE will be equal to VE. Now we are using our existing capital structure or existing gearing level. 3 into 5. So that will be 5 plus 3, 1 minus T, which is 0.7. All over VE, which is 5 times BA. BA is the one we've calculated, 0.86 from the oil and gas sector. Voila. Therefore, BE is equal to, use a calculator, you should get 1.22. Now this answers the first requirement. What is the equity beta? Now this becomes the equity beta we use in solving our CAPM. Now remember, our CAPM formula is KE RF plus the beta, which is the equity beta, which is this, return from the market minus the risk-free rate. This is also the premium. Now the examiner has given us a premium of 7%. So let's see, KE risk-free rate. The risk-free rate in this question is 5%. That's 0.05 plus the beta we just calculated is 1.22. They gave us the risk premium, which is everything in this bracket. Everything in this bracket is the risk premium, and they gave us as 7%. If you do this, you should get 13.54%. You can see it's very, very easy to calculate cost of equity using gearing and ungearing. Now let me give you a simple classwork. Try this, pause it, solve, and play the solutions. Alright, I guess you did that. I guess it was a little bit challenging because this question is an all equity finance company. But let's see if we can do it together. ACCA COC, an all equity finance company, it turns all equity finance. It means it doesn't have debts in its capital structure. An all equity finance company, there is no debt in the capital structure. So whatever beta you see here reflects only his business risk, because there is no debt in the capital structure, so there's no financial risk. That's what I mean. It tends to diversify into a new line of business different from its existing business. AKP equity beta is currently 1.3. A company operating in a new line of business have an existing beta of 1.3. Okay. Its gearing level is 40%. Risk-free rate is 4%. Return from the market is 9%. Gearing is debt over debt plus equity. Ignore what? Taxation. Ignore taxation. So let's see. I'm diversifying into a business, but I'm all equity finance. Now, what I would do is to ungear the business risk in this new line of business I want to diversify into. Remember the ungearing formula: BE is equals to VE all over VE plus VD 1 minus T times BE. So this becomes BA. Now the VE, remember, we're using the capital structure of the new company, of the new line of business we're diversifying into. And the gearing level for this new business is 40%. But one thing strikes out differently here. The gearing level is debt over debt plus equity. It is not like the first one we did that was just debt over equity. This one is debt over debt plus what? Equity. So what I would do here, let me quickly calculate what it will be. They say gearing level is 40%. And you're telling me it's debt over debt plus equity. And this will be debt. This now will not be, I will now break this into 2. Debt will be 40, equity will be what? 50. So now that I have that, I can go on. 50 over 50 plus sorry, this will be 60, not 50. 40 plus 60 is 100, so that will be 60. Sorry. Okay, that will be 60, 40, 40. There will be no 1 minus T because there is no taxation in the question. It was clear. Ignore taxation times 1.3, which is the existing beta of this company. Coincidentally, is the same with our current beta, but it doesn't matter. Just continue with the question. And when we do that, BA will give us 0.78. Now, because it's an all-equity finance company, there is no need for you to gear back again. But just for solving sake, let's just see how it looks like. Remember, our own current capital structure, we don't have any debt. So it's more or less like saying that equity is 100%. There is no debt. So equity is 1, which is like 100%, and debt is 0. Now, if we turn this formula upside down, let's say we want to gear back to BE, VE, VD, 1 minus T all over VD. Remember, there is no debt, there is no tax, and it's an all-equity finance company. So VD is 0, VE is 1, because we don't have any debt structure. So our equity is 100%. So this becomes BE, VE is 1 plus 0 all over 1 times the asset beta we calculated 0.78, and this looks like 1 times 0.78, which is equal to 0.78. So this is our equity beta. Now when we have this, now we cannot slot this into our CAPM formula to calculate cost of equity. Now KE, using CAPM formula, beta ARM, therefore KE will be, the risk-free rate in the question is 4%, so that will be 0.04 plus the beta we just calculated, 0.78. Did they give us premium here? No. I think they gave us the return from the market is 9%. That'll be 0.09 minus the risk-free rate, which is RF, which is we said is 4%, 0.04. If we solve this mathematically, KE will be equal to 7.94, 7.9, 7.9%. 7.9%. That's your cost of equity. The reason why we are doing this is this. If you're given question, you may need to calculate cost of equity first, calculate cost of debt first, find VD and VE, then eventually you now calculate WACC. At the advanced level, you may do all this on gear, calculate cost of equity, calculate cost of debt, and use it in solving WACC, then using the WACC for investment appraisal. As long as the business risk, the financial risk doesn't change. At the advanced level, if it's going to change, it's advisable to use APV. You understand? You can slot that when you answer questions. Sometimes the examiner gets fascinated by the fact that you understand when there's a need for you to use APV for investment appraisal, even if you're not going to solve anything about APV at this level. Remember, if you're going to diversify into a new business, a risk-adjusted cost of capital should be calculated, which you have to on gear from the industry you're diversifying into, using their existing capital structure, remove the BA and gear it into your own capital structure, existing capital structure. With these two examples, you can go over them again. Very easy and very simple in the exams. There are three ways the examiner can give you how to calculate VE and VD. Learn the three methods, because from here, what we'll be looking at is systematic and systematic risk. From there, we're moving to cost of debt. Eventually, we'll be solving working capital questions on Excel and the rest of them. Thank you very much for listening to ACCA Pinand e-learning. See you in the next session. Thank you.